Welcome to Looking at the Markets with David Modell. This is another installment in a series of videos that I'm making for beginning investors. And so you can start at the beginning, and any questions are okay. There are no embarrassing questions. There are no questions that are too beginner-ish, okay? Because that's what this series of videos is all about. So you can start right, all right? And by the way, I'm going to put my email address below if you want help with investing, trading, stocks, putting together a plan for your investing, because you really should have a plan. As they say, if you fail to plan, then you're planning to fail. So I can assist you with those things. Just shoot me an email at davidmodell@gmail.com. All right, so dividends. That's what this video is all about. You might have heard the name. You might know a little bit about it. What is a dividend? Well, for people who buy a stock or shares of stock for a company, sometimes the company wants to reward, or at least appear to reward, people who buy shares of their stock. Of course, they want to encourage people to buy their stock so that the stock price can go up. That's what causes stock prices to go up, when lots of people buy that stock, and that's good for the company. So sometimes companies will declare that they're offering a dividend to stockholders, people who own shares, all right? Not all companies, not all stocks have dividends, but some do. And a lot of the more popular ones offer dividends. Also, some ETFs, exchange traded funds, offer dividends. And if you don't know what that means, ETF, that's okay. Don't worry about it. That could be a separate video. All right, so what is a dividend? Well, basically, if a company is profitable, they can reward, or look like they're rewarding, stock owners by paying out a cash. They basically pay out cash. They give cash to the people who own the stock, okay? Usually it's cash. Sometimes they give stock shares instead of cash to people who own the stock. Or sometimes they'll even give property, but that's rare. Usually it's going to be cash in most cases. All right, now here's the thing. You have to be aware. I remember when I was much younger, and I thought this was free money. I thought you just buy the stock. If it offers a dividend, then, hey, that's free money. They're going to put free cash in my pocket. And so I bought the stock, and the stock price, I bought the stock and waited for the dividend, and hey, there it was. It happened. In my account, in my brokerage account, there was some cash, a dividend payout. But then I looked at the stock price, and it went down that same amount. The amount of the dividend payout, the amount that my account went up in cash, the stock share price went down that same amount. So really, altogether, my account, the amount of value in my account was the same. It really didn't change, because while I gained some cash, I also lost some value in the shares of stock that I owned. It was the same amount, all right? So they're basically, what they did was they took a certain amount of value, or of money, out of the value of the shares of stock that I owned, and just gave it to me in cash. In other words, indirectly, what they did was they forced me to sell off, or to sell parts of the shares that I owned, which is kind of interesting. All right, so although it may seem like free money, notice how the share price can go down the same amount as what you got paid, and that's what happened to me. And so I was a little bit disappointed. I thought it was free money. There is no free money really in the stock market. If it were just free money, if the shares of the stock stayed the same and they just gave everybody free money, then guess what? Everybody would just buy the stock shares right before the dividend payout, and then sell the stock shares right after the dividend payout, and just keep that free cash, okay? But it doesn't work like that. It's not so simple. All right, so just be aware that you can't game it. You can't, scheme and scam it to get free money. It doesn't work like that. All right, now, if Now be aware that different companies offer different dividends. All right, a typical dividend might be, I don't know, 2%, 3, 4% per year, maybe 1% per year, something like that. Some stocks, some companies offer more than that. You might see 8, 9, even I've seen 10 or more percent per year. But, again, first of all, be aware that's probably not just going to be free money. Also, yes, it is a good sign a lot of the time when a company raises their dividend that they offer every year. All right. If one year a company offers a 2% dividend, and then the next year it's and these numbers are annual, by the way. I mean per year. And then, so if they offer 2%, and then the next year it's 2.3%, then the next year it's 2.5%, whatever. If they are raising the dividends every year of a company, oftentimes that's a good sign. It's positive for the company and for the stock. Not always. There are no guarantees. And I'm not going to buy a stock just only because the company is raising its dividends consistently. But that's usually a good sign, because that means the company can afford to raise its dividends. The company probably has plenty of cash, plenty of capital, and if a company can afford to pay dividends and raise them consistently, that's oftentimes a good sign. In fact, there are companies called the dogs of the Dow, okay, the dogs of the Dow. These are companies in the Dow Jones, and if you don't know what that is, don't worry about it. Those are large companies, but we can talk about the Dow Jones in another video. But these are large companies that have consistently increased their dividends over time, okay? So oftentimes those companies do pretty well. Again, no guarantees, not always. I don't want you to buy a stock just because they have high dividends or because they're increasing their dividends. In fact, if a company pays a really high dividend, like more than 10% per year or something like that, it makes me wonder, are they trying to, are they desperate? Are they desperate to get people, to pull people in to buy their stock shares? Why are they offering a dividend that high? Is there something wrong with the company, perhaps, possibly, that they have to resort to extreme measures to get people interested in their stock shares? All right. Anyway, that's a separate issue. But oftentimes it's a good sign when companies offer dividends. All right. So there are some things you should know. First of all, the dividend is not usually paid just once a year. It's oftentimes paid 2, 3, or 4 times a year. It's all up to the company how they want to pay the dividends. For example, if a company offers or pays a dividend of 3% annually, and they make 3 payouts per year, so that'll be 1% of the stock shares price every time they make a dividend payout 3 times a year. All right. And the percentages are based on the stock shares price. So if they offer 3% dividend per year, that's 3% of the whatever the price of the stock shares would be at that time. Okay. Just to clarify. Also, some dates you should know about when it comes to dividends, and you might hear these terms, so I just want to clarify. There's the date when they announce the dividend. All right, a company will announce, when they're going to pay a dividend, what percent it's going to be, or what, perhaps what dollar amount it's going to be. All right, and then there's the announcement date, and then after that, sometime after that, there's the ex-dividend date, EX-dividend date. And you have to own shares of the stock, the company's stock, before the ex-dividend date if you want to get paid a dividend that time. All right. Once that ex-dividend date hits, once we reach that ex-dividend date, that's it. Forget it. You're not going to get a dividend payout for that cycle, for that dividend cycle, for that time. All right. And then after that, very soon after the ex-dividend date, it's like a cutoff date. Okay, you have to own the shares of stock before this cutoff date if you want to get a dividend payout that time. Then soon after that is the record date, when the company records, I was going to say writes down. I don't know if they actually write it down, but they record who owned shares of stock. On that day, they keep track of and take note of who owned shares of stock before the ex-dividend date. In other words, who's going to get the dividend payouts. All right, so they record that so they'll know. And then finally, later on, there's the payout date. You finally look in your brokerage, you look in your broker's account and you see some cash in there. All right, and again, not free cash, probably just some, pieces of your stock holdings were sold off. Okay, and you get a little bit of cash, but maybe your stock is worth a little bit less. Now, a lot of times, don't let that scare you though, because a lot of times after dividend is paid, yes, on that day the stock shares go down a lot of the time in order to pay the dividend, but then if it's a good company, oftentimes it recovers and the stock price comes back up over time. Again, that's if it's a good company. No guarantees that's going to happen, but I've seen that happen quite a few times. And so when you buy great companies that pay dividends over time, you keep that cash in your account, and meanwhile the stock shares usually over time come back up even if they dip. And so what you can do with that cash, yes, you can keep it as cash, you can withdraw it and spend it if you want to, but if you want to enjoy the compounding effect of stock ownership, then what you can do is perhaps take those cash payouts and buy more shares of stock with it. If you have enough money to do that. All right, that's a possibility, and that's a decision you have to make. But that's how compounding works. You just keep reinvesting any profits or dividends you make, and that could really add to your profits over time. It can actually multiply the profits over time. But that tends to happen over periods of years. So don't think that's going to happen overnight. All right. So that's what dividends are. That's the basics of it. All right. I hope this video was helpful to you. If you found it helpful, please give this a thumbs up on YouTube. Give the video a thumbs up and leave a comment and subscribe to my YouTube channel and hit that bell on YouTube so you can receive the latest updates on my financial educational videos. And again, you can contact me at that email address down there, davidmodell@gmail.com. If you want some help with your investing, putting together a plan, if you have questions, I can help you. All right, thanks a lot, and I'll talk to you again soon.